Welcome to those joining us. You're joining DFI's webinar, along with many guests that we have today in the form of Mix and others. So I will be introducing you to everybody very shortly. Thank you for joining us today. Just a few housekeeping things before I pass you over to our host. For those of you who normally join me on webinars, I'm having time off this afternoon and I've got some lovely people hosting for me, which means I can be a participant just like you guys today for a change. For those of you who don't know me, I'm Sarah Corley. I'm DFI's and it's my job to find ways in which the digital finance professionals globally across the world can come together and have different conversations together. And one of those ways is through webinars. Today's webinar is being recorded so that we can circulate the recording to maybe any of you that had to leave a little bit early or those who aren't able to join us today for the session. Just so you know, you are able to pop questions through to all the panelists today, and we want you to do that by using the Q&A function, which is at the very bottom of the screen. So if you kind of wave your mouse around on the screen, you'll see a little pop-up come across the bottom and you'll see one that says Q&A. Please pop your questions in there, and either as we're going through the webinar or towards the end of the webinar, we'll get round to answering all of your questions to date. If we run out of time and we don't get around to every question, we will try and answer the questions all by sending you both along with the recording. We'll send you along with some of the answers for the questions as well. We're now a couple of minutes past 3 and I can see we've got some attendees joining us, and I'm not going to delay talking about me much longer. I'm going to talk a little bit at the end of the webinar about other opportunities to connect with DFI in the future. So I'll come back and talk to you about that at the end. But for now, I'm going to hand you over to your wonderful host for the webinar today, Camilla. Camilla Nestor is CEO of Mix, and she's going to tell you more about what the company does, as well as their amazing Inclusive Fintech 50 competition that they had. Fintech is the key word right now. Everyone's talking about Fintech and Googling about Fintech. And there's some amazing lessons from this competition that we can learn about how we look at Fintech and how we fund and sponsor and look at how our criteria when it comes to assessing whether a Fintech is good or not. So Camilla, over to you.
Great, thank you so much, Sarah, and thanks to DFI for hosting this webinar on Inclusive Fintech. As Sarah noted, I'm Camilla Nestor, the CEO of Mix, the data provider for inclusive finance. We see, like the rest of you, that Fintech is really revolutionizing the financial services landscape and driving billions of dollars in investment worldwide. There's a growing sense of the promise Fintech has to create more inclusive financial services ecosystems by reducing client-level transaction costs, increasing transparency, narrowing the gender gap, and creating innovations in business models that allow cost-effective outreach to more people, particularly in poor or rural contexts. However, despite this widely heralded potential, the growth of inclusive Fintech remains limited. We see that many innovative companies are struggling to secure sufficient capital to reach customers at scale. Meanwhile, investors say they would like greater visibility into the full landscape of fintechs and would like better information to compare and benchmark performance. Fintech stakeholders and investors repeatedly cite this as a central challenge, impeding their ability to identify, assess, partner with, and invest in fintechs, especially those fintechs focused on driving financial inclusion. At Mix, we're focused on data solutions to these barriers and have a number of initiatives focusing on creating greater transparency, visibility, and data standards for digital and fintech. Inclusive Fintech 50 is one of those initiatives. It was conceived in conjunction with our sponsors in an effort to help address these challenges by highlighting 50 emerging fintech firms via a credible, data-driven process and an independent judging panel. Inclusive Fintech 50 is sponsored by Visa and MetLife Foundation with support from Axione and IFC and implemented by Mix. We're really pleased to have with us today a terrific set of speakers. Vikas Raj, Managing Director of Axione Venture Lab, Hilary Miller-Wise, Founder and CEO of Tula, and Benny Sabanito, Digital and Fintech Lead at IFC. In addition, I'm going to be sharing with you a few of the insights arising from the overall applicant pool of inclusive fintechs, and then we'll have time for some Q&A at the end. So we'll start with Vikas, and Vikas, over to you.
Great. Hi, everybody, and thanks for the introduction, Camilla. I'll tell you a little bit about Venture Lab and why we do what we do, and why we think this initiative is so important. So we are Axiom Venture Lab is a seed stage investor in fintech for inclusion. So we invest in early stage startups globally that are using new technologies, new business models to expand access to, improve the quality of, and improve the affordability of financial services for the underserved. And our belief is really that new technologies are finally making it possible to identify, acquire, understand, and ultimately serve the 3 billion people around the world that are currently underserved by the financial system. That's consumers, that's small businesses that were previously deemed too expensive or too risky to serve, and are now, and technology now makes it possible. We also believe that startups are the sort of greatest initiators and testers of innovation. They create products that actually matter for customers because it's the only way that they can get off the ground. They get to customers affordably because they have to, because they have very little money. So they have to figure out ways to sort of make it work. So our job is to support those companies, support those startups, many of whom have been sort of tragically underfunded by the institutional investor class. What we do that by providing primarily investment capital. So we usually invest equity or convertible debt, typically $400,000 to $500,000 in these companies. We're coming in at the earliest stages. So these are companies that are usually have a product in market, have a little bit of proof of product market fit, but very little else. They're not profitable. They have small teams. They're still kind of figuring things out, which means they need money, but also support. So besides the capital, we get very actively involved with our companies. We get involved with governance through board, and we also have our own in-house, what we call portfolio engagement team that helps our companies on targeted operational strategic issues. And we invest across sectors. So we are everything from SME credit in Mexico to farmer insurance in Nairobi. As long as there's real innovation and real financial inclusion, it's something that's sort of interesting to us. We recently, as you can see at the bottom of the slide here, we recently closed our second fund in partnership with Axiom and 14 new LPs, new partners. It gives us an additional $33 million of capital to fund our next phase of growth. So we're very excited to be able to continue our work with our partners' support. The next slide shows our portfolio. We've invested in 41 companies over the last 6.5 years or so in 30 markets. And these companies have by and large done quite well. They've served over 3 million consumers, over 250,000 small businesses. And as you can see, they're pretty well diversified across the globe. They're in Asia, Africa, Latin America, and the US. I'm happy to answer any questions about any of these companies in particular at the end of the session. But we are, as you can see, we're really kind of globally opportunistic. Sort of go where the innovation and the opportunity is. If you go to the next slide, you know, we raised this fund, and a lot of the work we've done is part of our mission of shining more of a light on this space, on the innovations that are happening in financial inclusion. Our ultimate goal is incorporating those 3 billion people in the financial system. But that only happens if more companies like ours and other entities that Camilla sort of touched on, regulators, corporates, banks, if they all sort of understand and interact, understand this problem, interact with each other, perhaps even replicate what these companies, what our startups are doing to ultimately get services out to the excluded. So it's still a massive need. Our small fund is a a drop in a bucket in an ocean, but we're trying to get the word out about how these companies need capital and support, and how big of a problem this is. And that's why efforts like the IF50 are so critical. They're critical to getting more companies on the map, and so we're very happy to be a part of that effort, and looking forward to answering questions.
Great, thanks very much, Vikas. And Benny, over to you.
Hi, this is Benny Sabonito from the IFC. What I would like to talk to you about is explain to you how FinTech is positioned within IFC, and then more broadly how IFC's work on FinTech is positioned within the World Bank Group. And then again, I'd like to say a few words as well around why is it that we engaged in this initiative. So IFC has become essentially one of the largest dedicated investor in FinTech in emerging markets. We currently have, as you can see from this slide, 49 direct investments. We actually have investments also in 4 funds, including with our partner Acción, and have invested essentially just over $500 million in this space. We started a long time ago, probably before many of us were actually considering this space, FinTech. But as you see, and really use the slide just as the representation of the growth, the portfolio has grown significantly. And one thing you will not see here is that it also has diversified very gradually. So the first half of the slide essentially reflects primarily payment solutions. Then on the mid side, you're starting to see some credit providers, some insurance, some platform for personal financial management, supply chain finance solutions, and then finally even capital market solutions where technology are helping to bring transparency in that space. The evolution was sure intentional, but also kind of reflects how much broader the concept of FinTech and the applications of financial technologies have been in the financial services space, and how gradually more and more relevant they've also become for emerging markets. While payments is a well-known solution, and in many cases you probably see as much innovation in the payment side coming from emerging markets as you would from advanced economies, that's not necessarily true for some of the other solutions or other product categories that I've mentioned. And I think the research that we did on the IF50 reflects that somewhat. So we are an investor, and in this case, what I'm showing to you here is our kind of venture investments, equity investments that IFC is doing. We're also a very large investor in banks and financial services overall, not necessarily with equity instruments exclusively. Oftentimes we provide credit to providers, but we as IFC see essentially this engagement, this envelope in FinTech as a way to support innovation, and at the same time actually to continue learning and keeping the pulse on what's happening in the market and how these innovations can transform the way the financial services are delivered and the business models of the providers in developing countries. We do so that way. We do so also by having a fairly large portfolio of advisory projects, advisory services, where we essentially provide technical assistance to financial institutions to help them oftentimes with the strategy, the delivery of digital channels, and the design of new products. So I think it was mentioned earlier, digital is really becoming it's going everywhere in the financial services space, well beyond what we might consider just early stage FinTech companies. Another way in which we engage with technology and financial service providers is by trying to strike partnerships. Partnerships with donors in terms of supporting some operational research, understanding the development impact of some of these solutions and the potential challenges that come from them. and partnerships also leveraging our role as IFC, as a large investor, but also as a development finance institution, to broker partnerships. So one example is APIX, a project we're doing with the Asian Financial Innovation Network in Singapore, where we have essentially sponsored the creation of a marketplace where fintechs and the incumbents, banks, financial institutions across the region can partner to develop new products and services. So now how we got involved in the initiative. With our partners, Visa, MetLife Foundation, Acción, and then later the Mix, we kind of identified a problem. The space evolves rapidly. You saw also the differentiation of products and services represented in our own portfolio. The number of investments is growing even more rapidly, and we are a tiny investor compared to the global trends. What we think, or what we thought was, there's always the risk of a bit of a hype in these situations, and so there was a question of trying to understand or identify and flag those amongst these early solutions that we were, that held the most potential, both for financial inclusion as well as for the development and growth of their business. We had seen a lot of ranking efforts, but many of these ranking efforts lacked the transparent methodology that would have actually convinced us to look deeper into those companies. And to be frank, in many situations, we kept seeing the same names over and over. So we set to test an hypothesis, and we set to test an hypothesis that essentially, hoped to be able to leverage and collect data to try to create, a structured methodology that would identify the businesses that score best on a set of categories. And I think you'll enjoy seeing a presentation from Mix that discusses this. I think they were a great partner in this endeavor. The idea is lack of data and visibility mudds the waters, and so if we're able to identify in a convincing fashion some of the most promising firms, we would have a significant impact on their visibility and their future potential for fundraising. I think we did quite well. It was an experiment. We'll see. The results are still very much pending, but we hope that this is another way in which we can catalyze interest from the private sector in inclusion and in emerging markets. And that's, parallel to our direct investment function, probably one of the most important objectives that IFC has for itself, to try to target and catalyze private sector investments and impact investors in this space. I'll stop here, but happy to elaborate on any of this through the discussion.
Great. Thank you so much, Benny. That was a really nice introduction of the initiative and sort of why it came about and what we were collectively hoping to achieve. So we have a really interesting set of insights that have been generated from this competition, and I'm just going to take you through a few of the highlights. There's a lot more in the white paper that's on the Inclusive Fintech 50 website that just came out a couple of weeks ago. So first of all, we had an excellent response to the call for applications with 400 eligible applicants representing 72 countries, collectively reaching 70 million customers with over $800 million in capital raised. In terms of the product breakdown, among the winner group, just under 30% were focused on credit, 26% on infrastructure, 16% on payments, and 14% each on insurance and personal financial management, which includes savings. Before we jump into the learnings, I want to share with you how we defined and approached the question of what makes an inclusive fintech. The competition's approach to understanding inclusivity looked at a few questions: the target market identified by the fintech, the accessibility of the product, the difficulty of the problem the fintech was seeking to solve, and the impact of the innovation to the end customer. By asking fintechs to describe their target market, it was possible for the judges to assess the degree of financial exclusion of the end customer as well as the applicant's understanding of that particular audience. Whether a fintech delivered its product through a smartphone, a feature phone, or some other method also demonstrated, to some degree, whether its product is easily accessible. Applicants were also asked to explain the problem their firm was addressing, and their answers demonstrated their grasp on the issues that their end customers face when it comes to using financial services. In addition to inclusivity, there were 3 other pillars in evaluating the fintechs: traction, scale potential, and innovation, using both quantitative and qualitative metrics. But because the term inclusive is thrown around a lot, we wanted to give you a sense for how we were digging into that in this process. So what did we learn from this very impressive group of companies about the state of inclusive fintech around the world? In short, we see some issues that need to be addressed in order for fintech to deliver on its promise, and we see some good news that should be celebrated. So first of all, we saw some interesting themes in the capital flows to the 400 eligible fintechs and identified areas where collective action could move the needle. First, as shown here, we saw a significant variation in funds raised from region to region, with a material disadvantage for being an Africa-headquartered fintech. African fintechs raised average annual funding of $260,000 compared to $626,000 for South Asia. This discrepancy held when comparing African-headquartered fintechs to other parts of the world as well. But what's really interesting here is, for the most part, those African fintechs reached just as many clients as the better funded fintechs in other regions. In other words, African headquartered fintechs reached more clients per dollar invested. Related to this, we also looked at funding by stage and found that fintechs in East Asia were the most likely to have raised venture series funding, and this includes fintechs around the world, including North America and Europe. So 33% of fintechs in East Asia had raised venture series funding versus 18% for the pool overall. African fintechs were relying far more on self-funding. So 48% of African fintechs relied on self-funding versus 30% in the pool overall. So when we look at this and kind of the outreach data as well, for us, it's a really interesting question around what we could do if we could generate more capital going into African fintechs. We see a lot of potential here to address this discrepancy. Second, in addition to concentrations between regions, we saw significant concentrations of capital within regions, with capital crowding into a small number of players and overlooking the vast majority. So both Vikas and Benny mentioned this, like we see this trend where investors want to go where others have already gone. And we know that many investors rely on their networks to source pipeline. But in practice, what this means is that lesser known startups are often overlooked. There was an excellent Village Capital report from a couple years ago that showed in a 2-year period in East Africa, 72% of the capital into digital startups went to just 3 companies. We were curious to see if these types of concentrations still exist, and it was certainly the case in the Africa cohort. So of the 110 fintechs headquartered in Africa, just 7 fintechs captured 70% of the funding. So 7 out of those 110 captured 70% of the funding. What this means really is that investors and funders are missing out on innovative ideas. And our hope is that efforts like Inclusive FinTech 50 create more visibility for high-performing fintechs and also help to create more equitable capital flows. Next, we saw some interesting things with regard to gender. Fintech startups with at least one woman founder or executive reported raising 95% of the funding of their male counterparts. Given research showing much bigger gaps in the tech startup world, we think this is promising, but we would like to see it at parity. As we would expect, there was some regional variation. In Africa, Europe and Central Asia, and East Asia, women-led fintechs raised an average of just 50 to 70% of their male counterparts. In addition, there were a couple other interesting things with regard to gender at different fundraising stages. At the early funding stages, at the seed and self-funding stage, women-led fintechs raised 80% of what their male counterparts did. But that flipped in the venture series, where women-led fintechs raised 112% of what their male counterparts did. This points to a potential issue with access to financing at the critical early proofing stages for products developed by women-led fintechs. Finally, on the gender front, we saw an interesting correlation that we're eager to dig into further between female founders, female-led fintechs, and outreach numbers. So women-led fintechs composed 19% of our overall applicant pool of 400, but that group accounted for 1/3 of the total outreach. And this was fairly consistent across all the product categories. So interesting findings with regard to gender, and we look forward to digging into these further in the next round of Inclusive FinTech 50. The final insight I want to share with you today is about the network effect. Our data shows that investment in building networks, whether incubators, accelerators, or local competitions, has an outsized impact in terms of entrepreneurs' ability to raise funding. In our applicant pool, networked fintechs raised 1.5 times the funding of their non-networked peers. This is true even when looking at annualized funding to compare younger and older fintechs. In Africa, the network effect was even greater at 2.0 times. This network effect seems to be self-reinforcing over time as the gap between funds raised by networked fintechs and non-networked fintechs increases over time. So to sum up, Mix overall is really happy to be playing a part in helping to reach lesser known startups, helping to create the visibility that can bring some of these innovative products to light and connect these early stage players with the resources needed to scale and reach the underserved. As I mentioned, there's a lot more analysis in our white paper, which we hope you'll check out. And we also hope you'll follow the competition as we launch the next round next year. Now I'm pleased to turn it over to Hillary Miller-Wise to tell us about Tula.
Terrific. Thank you, Camilla. So again, my name is Hillary. I am the founder and CEO of Tula. And I am apparently one of the people who's raised between 50 and 70% of my male counterparts in Africa. So I want to thank Mix, Action, IFC, MetLife Foundation, and Visa for inviting me, and certainly for selecting us among such an incredible group of companies. I'd like to talk to you a little bit about the problems that we're solving for and the solution that we are bringing to bear to address particularly access to financial services among smallholder farmers. So if we go to the next slide, sorry, we can skip to the next. Thank you. So the problem that we're solving for really relates to the large number of smallholder farming households in Africa that, as we know, are producing well below their potential. The FAO estimates that these farmers are going to need to increase production by about 70% to meet the rising demands for food on the continent, which is driven in large part by the doubling of the population by 2050, and of course by increased consumer demand in urban markets as there's a growing middle class, and the expansion of cities across the continent. In our view, there are really 4 reasons why smallholders struggle to be able to increase production and increase income. The first is they lack access to quality inputs like fertilizer and seed. Related to that is lack of access to credit, which is a main reason why they struggle to purchase those inputs, because it's a low cash flow point of the year for them when they are planting for their next season. Third is access to information. So even when farmers do have access to credit and inputs, they often don't have the knowledge and the best practices to be able to increase production, especially in a context of climate change when their practices have to adapt. And then finally, even if you were to overcome all 3 of those obstacles, clearly they still struggle to access market. In most countries in sub-Saharan Africa, smallholder farmers are price takers. Typically, they would sell to farm gate brokers and don't want to incur the risk and cost of taking their produce to a distant market. So from Tula's perspective, we looked at these 4 challenges, and we tried to identify a way that technology could be used to address those challenges. So if we jump forward. Before I get into our solution, let me just talk a little bit about the need for credit in particular. So if we look overall, the unmet demand for the types of products and services like inputs, credit, and market linkage services is estimated to be about 160 trillion. If we just look at credit, and if we look at Kenya alone, less than 4% of all lending in Kenya goes to agriculture. The estimated unmet demand for credit among smallholder farmers in Kenya is $1 billion. And the challenge is the incumbents, as Benny mentioned, are really not serving this market, especially in a market like Kenya where there is an interest rate cap, has been an interest rate cap for years, and many of the banks and MFIs then are moving further up market. So if we jump forward. The opportunity, the flip side of sort of the disappointing or upsetting story that I'm telling is this tremendous opportunity in urban markets. With the combination of the doubling of the population, as well as the increase in the middle class, what we're seeing is an explosion of consumer demand. So McKinsey issued a report earlier this year in which they estimated that the growth in consumer spending in sub-Saharan Africa would be about 645 billion, of which 167 is in food and beverages. That creates a tremendous opportunity for farmers to meet this increased demand, but they have to overcome the challenges that I mentioned in the beginning to do that. So if we move forward. Great. So our solution is a marketplace. We refer to ourselves as an online to offline marketplace that allows farmers to buy inputs on credit, to get agronomic information, to farm better, and we help link the farmers to buyers and enable them to sell their produce at a good price. We've been able to demonstrate, and I'll talk a little bit about the effect, but we've been able to demonstrate significant impact on a net profit basis for farmers who engage with us in all three areas. Farmers don't necessarily need to. They can buy inputs on credit from us only, or they can sell their produce from us, but the net effect is greatest for them when they are engaging on both sides of our platform. So going forward, this is just a quick view of the farmer journey. The way that it works with our customers is most of our customers still only have feature phones. They wouldn't have a smartphone, so we're limited in what we can do and how we engage with them through technology. What we do is we take technology and we layer it on existing networks of people, of agents, of retailers, of channel partners. So a farmer who wants to purchase inputs from us can go to one of those agents, whether it's ours or our partners or an agrovet retailer that's on our platform, and they can place an order for inputs. At the same time, they are providing us with KYC, know your customer data, that we're using to then kick off a loan origination process and a credit assessment process. So we have our own credit score that uses a number of different variables from psychometric data, demographic data, satellite data, etc. We then make a decision about whether to issue the loan or not. If we decide to issue the loan, we send an electronic voucher to the farmer. He goes to one of our participating retailers and collects the inputs. We then pay the retailer for that stock that he supplied. At that point, we send very tailored information to the farmer because we know a lot about them. We know where the farmer is, what he's growing, what inputs he got, and when he got them. So we send very tailored information that's timed with the crop cycle and timed with weather. And then just before harvest season, we're projecting when farmers are expected to harvest because we have that data, and we're taking bookings from them. They're telling us they want to harvest on Wednesday, and they want to sell 50 bags of potato through us. We are then aggregating that supply and linking them to wholesale buyers in urban markets. We actually coordinate the third-party logistics, and we manage the payments on the back end. So jumping forward. So As I mentioned before, the impact is significant for the farmers we work with so far, and we think there's even more that we can be doing. Farmers who take inputs on credit and who sell through us are able to achieve 143% higher net profit, so the bottom line, not top line revenue, than farmers who don't. Again, we're very pleased with that impact, but I think there's a lot more that we could be doing and even greater impact we could be having. Jumping forward. And I think finally, we put some of these quotes here, largely because one of the things that we're trying to do is position ourselves as a company that is really focused on customer service. A lot of these farmers have had very mixed experience with incumbent banks, and often the relationship is a very adversarial one. Clearly, anytime that you are providing loans, you have to ensure repayment, but there are different ways to do that. We, on our platform, are able to recover loan payments through the market linkage. So when farmers sell through us, we deduct the loan balance before we pay them. So it's one way that we're able to work with farmers in a way that's more collaborative, and of course, still ensure the quality of our portfolio and the growth of the company. So with that, let me stop and happy to take questions.
Great, thank you so much, Hillary. So I'll just remind the participants to type your questions into the Q&A box. We're going to start with a few questions for each of the panelists and then move into open Q&A. So Hillary, let's stick with you. What would you advise the group listening that we should be doing differently to help surface and understand a more diverse pipeline of potential fintech investees and partners in Africa?
Yeah, thanks, Camilla. So I think some of the data that you pointed out in the beginning was very eye-opening for me when I read the white paper. I think it does map to my experience personally. As you mentioned in your presentation, often pipeline is sourced from within a particular investor's network. And sometimes that can be a bit of an echo chamber. And so I think there need to be ways that investors can create pipeline that goes beyond the forums that they surface those companies. I think secondly, you know, there was a study that was released years ago by, it was printed in Harvard Business Review about women entrepreneurs and how differently investors will engage in a pitch session in terms of their questions between women and men. And I think there's just an inherent bias that exists that investors need to give thought to. It's usually unintentional, but I think it does come into play to make it more difficult for certain types of entrepreneurs, women, people who are first-time entrepreneurs, et cetera, whatever that bias is, makes it more challenging. And so I think finding unique ways to enable entrepreneurs to pitch. I'm not or where the pitch is given by someone other than the entrepreneur. So I think there's some creative ways that investors could also try to identify a broader pipeline with the recognition that they're trying to assess very quickly companies that they think have the potential to grow, and they're concerned about their own risk exposure. So wouldn't want them to compromise on those criteria, but I do think that there are ways to broaden the pipeline and allow firms that do have the potential to rise to the top.
Great, thank you, Hillary. It's a really kind of thoughtful response. I think let's shift over to Vikas. So Vikas, we know that low-income households have a range of financial needs. We also see that fintech solutions often tend to be highly targeted, in some cases niche. How does Axion Venture Lab view the potential for fintech to deliver on more integrated solutions or one-stop shopping to meet people's financial needs?
Yeah, it's a good question. One of the things that and I sort of touched on this earlier, one of the things we love about startups like Tula, and the reason we think they can be so catalytic is that they can't really start with a suite of products and hope they are relevant to a customer. So just sort of inventing 2 or 3 things and going out to market doesn't work for a startup, because they won't get traction, they won't generate revenue, they won't be able to cover costs. So they need a hook. They need something that people really need, and often that is a very kind of specific product, a specific use case. It's highly targeted. Several years ago, Venture Lab has been around for a while. Several years ago, we sort of thought that would lead to this sort of unbundling of services. So you no longer had a large financial institution, a one-stop shop, as you said, providing a full suite of services. A whole variety of players would provide the specific services that these underserved consumers or small businesses need. I think what we're seeing now is that many of our companies have sort of realized that they are the first contact point that many of their customers have with a formal financial services company, a formal and a formal provider of some kind. These are companies that are already interacting with this customer, so they have an opportunity to provide other services. So we have a company in Karachi called Days that starts with a very small dollar loan, but they're now also offering insurance and savings products on top of that. We have a company in Austin, Texas called Self-Lender that really started with what they call a credit builder loan. Now, actually just this week, they added a credit card product on top of that, because the need is there, obviously, for these consumers to have a full suite of appropriate and relevant products. These fintech companies have a unique understanding of that customer through their interactions with them with that hook product. They have an access point that is more affordable than potentially what a bank could do. So they can become, after they've built that relationship with a hook, something that looks more like a marketplace, or even offer some of those services themselves, depending on their maturity. So I actually do think we're going to continue to see a trend in that direction. Companies that have gotten to a certain point with their core product, fintech kind of startups that have gotten to a certain point with their core product, are going to begin to offer other products and services and start to look a little bit more like one-stop shops, but one-stop shops that are continue to create products that are highly relevant for their customer bases.
Thanks, because it's very encouraging. So good to hear. And now, Benny, over to you. So as one of the, IFC is one of the largest investors in financial institutions worldwide. How does IFC view the future of inclusive finance? Will fintechs become partners of financial services providers, or will they disrupt and displace them? How are you viewing the evolution of the landscape? Benny, I think we can't hear you.
Oh, can you hear me now?
Yes.
Okay. I think I'm very much aligned with what Vikas just said, and other observers of the space have also highlighted. I think that there was an initial idea in which, or observation, where fintech innovators would disrupt the space, right? And the partnerships. So, and Vikas alluded to one trend, which is essentially the, I guess, rebundling of services, where fintechs are realizing the potential, or innovators essentially are realizing that they have acquired a captive audience and try to build services and value add for the customers. I think there's another dynamic that we're seeing, which was probably even older than anything. It's always been there, but I think it's something that we shouldn't exclude necessarily, which is the more traditional B2B player, in terms of fintech providers providing services to other businesses, many of which could be incumbent bank financial institutions. So white labeling or outsourcing of certain functions like cross-border payments for customers, or credit, digital credit to a certain segment of the population, can happen independently, but can also happen as as part of a collaboration between the banks and the fintechs. And I think if I want to, if there's something I can add to that discussion is that we believe this is a strong opportunity, and there are areas where fintechs are going to have a very hard time competing with banks. One of the main ones is likely going to be access to capital, especially on the credit side of things. And so these connections and these partnerships, and earlier in my intervention, I mentioned this project we're doing in the Asian region, trying to link and promote these engagements is quite relevant. We also see from the IF50 white paper that business models are not necessarily only business to consumer or business to business, but actually the majority of the business models we researched through this effort was falling somewhere in between, which I think oftentimes, to the merit of the flexibility of fintech business models, shows also an ability of doing both, essentially, of being both a service provider to other players as well as a direct-to-consumer platform. And I think that's really important for identifying ultimately for each market to identify the best path towards universal financial access and inclusive finance, in the sense that I think a key element and a key underlying factor for all of this is efficiency and better quality of services. And it doesn't really matter to me as an observer who delivers those, as long as those happen in developing countries and elsewhere.
Great, thanks, Benny. So we have some excellent questions coming in from the participants. And so I think I'm going to start by grouping together a couple of questions for Hillary on Tula. So Hillary, just confirming the geographic reach of Tula, does it work only in Kenya? And then a question around, have you found in any of your markets of operation that farmers will benefit from real extension services in addition to SMS tips? Would that fit in your current model? And then just related to that from the same person, how do you find that the model works from a sustainability perspective once you add on additional services?
Yeah, great question. So we started 2 years ago in July 2017. Our focus is Kenya for now. We will then expand into other parts of East Africa, most likely in 2021. Great question with regard to extension services. It's a tricky one because providing extension services on the ground, so in person, is very expensive. When we were developing Tula, we looked at 1 Acre Fund, and we said, well, how could you do 1 Acre Fund, which is a nonprofit? How could you do that, but profitably as a for-profit business? And there are a few things that we said. Number one, we couldn't work in maize. It's too much of a commodity. It's a very challenging crop. Number two, we couldn't really target subsistence farmers. That level of farmer probably does need more subsidy. And three, we couldn't provide the kind of hands-on intensive extension training that they do because it really just destroys our unit economics. The last is we needed to add market linkage. That was a critical piece to becoming an end-to-end one-stop shop for farmers. So hopefully I'm answering both questions at once. Right now we provide agronomic information over SMS, but to do the hands-on, we have to partner with either NGOs or our input supply partners who are providing training, and we ride on their footprint and resources to be able to do that.
Great, thanks, Hillary. And so now a question from actually another Inclusive FinTech 50 winner, from Chris Chawanka. This is actually really interesting and I think directed to all of you. So he notes that there's a tendency to gravitate, among early stage fintechs, a tendency to gravitate towards big name partnerships. And he asks, what about fintechs working with each other? Has Tula done that? And what might that look like? And then from the investor perspective, he notes Axion Venture Lab has made introductions for his fintech to a member of their portfolio for collaboration. But is there an opportunity for more collaboration beyond these sort of grassroots, spontaneous channels between early stage fintechs?
Yeah, maybe just to answer from our side. I agree wholeheartedly. There needs to be more collaboration. We do collaborate with a few partners. So one example is a solar irrigation equipment company that provides financing to their farmers for the irrigation equipment, it's a nice complement to the services that we offer. We work with insurance partners. So we have a partnership with a company called Acre Africa, where we offer health insurance to farmers as a benefit for good repayment. I think there needs to be a lot more of that. There is a tendency, I think, to be concerned about competition or not wanting to share data. I think that's probably a little bit misplaced. We collectively, many of us, could benefit from collaborating and have much greater impact in the sense that, you know, we would be able to leverage each other's strengths and reach many more farmers with a broader suite of services than we could alone.
I can just touch on that briefly too. I mean, Chris, you mentioned that we've made an introduction. I mean, I totally agree that there's a lot to be learned from fintech startups working with other fintech startups. It might not be sort of necessary for as a customer or a provider of capital, but it's certainly it's nice to have a network of folks that are dealing with similar problems that you can brainstorm with. What we find is that many of our companies, whether they are doing SME lending in Mexico, like I said, or insurance in Africa, like I said earlier, they're actually facing a lot of the same challenges, trying to get to a lot of the same solutions. So what we do once you're in our portfolio is actually every one of our CEOs, as well as our sister fund Quona CEOs, get together every year and a half in The Hague, and we do a 2-day closed door session that we call the CEO Forum, that allows people to sort of let their hair down and talk about all of the big issues that their companies are facing and learn from each other. A lot of those, the meetings we do over those 2 days lead to extensive interactions between our CEOs afterwards via WhatsApp groups and phone calls and things like that. So I find now that many of our CEOs are independently connected. With the third day of that, the first 2 days of the CEO Forum, the third day is something we do that's opened up to everybody. And we actually get a lot of other CEOs in the room for that, and they get a chance to connect with our CEOs. So that might be something worth exploring. And then ask us. I think if you were to send an email to me or Benny, I'm sure we'd be happy to help connect people on this call with people that you think that could be relevant or helpful. I really strongly endorse the idea of building these sort of global fintech startup networks, because I think there's a lot of value to be had there.
Yeah, once again I find myself saying whatever Vikas said is exactly true. Also for IFC, we also on a year and a half basis have portfolio company CEOs come together. We tend to invest at a slightly later stage, so it's probably a different meeting and set of conversation. But it is, you know, once a portfolio company once a company becomes part of the portfolio, my colleagues do you know, very actively look for opportunities for knowledge sharing. Partnerships, they might not turn out to be partnerships, but certainly knowledge sharing and experience exchanges is probably the more accurate way of defining those. For portfolio and non-portfolio companies, I mentioned this Asian experiment a few times. We do throughout advisory services. We have another program called DigiLab, which is across Latin America and now being rolled out in Africa and in Europe and Central Asia, which is focused at the incumbents, the financial institutions. But again, to the risk of overstressing this point, it's helping her develop digital strategies, it's helping them think about opportunities for partnerships and engagements with fintechs in the space. And I know that I believe that in a number of these events we've actually ultimately organized some connections and link meetings across players. So
Great.
that's just another.
Okay. Thanks, Benny. So I think I got a couple clarifying questions on the data I shared, so I'm going to clarify those, and then we have one more question for Vikas and Benny. The question was around the breakdown among the sample between B2B and B2C, and it was actually about roughly 25% B2C, 25% B2B to C, sorry, 50% B2B to C, and roughly 25% pure B2B. And all of the data that we received was reported via a confidential portal from the companies to Mix. So a question for Vikas or Benny. I think this will be our last question. Based on your rich experience in impact investing and inclusive fintech so far, what are the large problem areas in inclusive fintech that you wish startups would solve but are not getting addressed well enough to your satisfaction?
Because let me try to start. This is a challenging question, but I would say probably an easy one to identify is I think we haven't really cracked insurance in many spaces. I'm not sure if it's the fintech's fault or if it's the fact that it's all linked to that it has so many other complexities that are not necessarily linked to the financial services itself, and probably also the applications of financial services such as for basic services such as access to electricity or other basic goods, I think are still very much early stage and could we will certainly see more evolution around those. Finally, I think I would probably make an overall plug for the jury still being out on some of the credit solutions, particularly on the consumer side, but also on the SME side, where I think there's space for fintech to grow, but also to be very careful about consumer protection and about the potential unintended negative consequences that could result from some of the interventions that we see in the space. So I would just leave it here. I mean, it's broad strokes, would deserve a much longer discussion.
Vikas, you're on mute.
I'm on mute.
Okay. Yep.
I think insurance is very much one of the spaces that we're sort of trying to do more work. We're an innovation investor. We're a very early stage investor. So sort of while the forces that drive innovation in a lot of these markets have remained consistent over the last 6 or 7 years, it's higher concentration and availability of technology, of data, and volume and of data being created. The sort of sectors that we're interested in continues to evolve. Insurance is very much a space that we want to do more. I think I'll just throw out a couple other ideas. We're really quite interested and are doing a lot more in the ag space. Businesses like Tula that are figuring out how to partner along the supply chain to provide services to farmers who have really been probably one of the most ignored groups in the financial services space over the course of history. We are continue to be focused on small business finance, although we've done a lot in sort of pure small business credit in partnership with the IFC in many situations. So we're starting to look at, hey, what are the other sets of financial services requirements for small businesses? So more sort of holistic solutions for micro businesses or even freelancers entities that need bank accounts and receivables finance and the ability to digitize their invoices, things like that. You know, and by the way, we write about a lot of this stuff on blogs and the like, but those are three sample sectors of things that we're excited about.
Great, thank you. I think with that, we'll conclude this webinar. Thank you so much to our three panelists and to DFI for hosting us. And also, we know we didn't get to every question, but Sarah's going to help us download those, and we'll try to, Sarah, maybe you can tell us how we could respond to those offline.
Absolutely. And thank you so much, Camilla and the panel, for being with us today. I've really enjoyed the session. It was really amazing. Hilary, I'm so impressed with that impact, 143%. That's absolutely amazing. And Vikas and Benji, I'm kind of really glad in some ways that you mentioned insurance as being one of the areas that you are expecting, would like some more from, because actually that's the focus of our very next webinar. So both of you are very welcome to come along to that one next week, the 9th of October, where we have one of your winners actually, Jeremy Leach from Inclusivity Solutions, presenting along with Senfree, the think tank here based in South Africa, who've done a lot of research in Africa around insurance and insurtech. So a lovely link there. So thank you for that nice plug that worked really well for our next webinar. And I'll be sending a recording and also some of the Q&As we never got around to answering to everybody. And also I'll be telling a little bit about one more thing, which is we talked about conversations and networking, and DFI actually already have an amazing platform with over 1,000 members called the League of Digital Finance Professionals on LinkedIn. So if you are looking to expand your network, please do join us, and in that LinkedIn group, you can send a link to request, and I approve the people who are joining the group. And it's a really good way for us all to stay connected, to share. It's everybody across the DFS space, from the venture capitalists through to the development organizations. I know the Mix team are already part of that group, and we share a lot from the likes of Mix, Action, IFC, etc. So it's a really nice place for us all to continue this conversation. And thank you very much for everybody, and have a wonderful afternoon. And hopefully we'll see you all in our next webinar.
Thanks, Sarah. Take care.
Thanks, everyone.
Thanks, everybody. Thanks for joining us. Bye-bye.
Take care. Thank you.